Good morning, everybody. Welcome to the Reserve Bank. Welcome to our news conference for our March monetary policy statement. I'm Alan Bollard, Governor. The Reserve Bank today is leaving the official cash rate unchanged at 2.5%. The New Zealand economy has been recovering broadly as we've been expecting, and growth is now predicted to increase further through 2010. Trading partner activity has recovered a little faster than we expected. Currently, growth is strongest in China, emerging Asia and Australia, but it's been more muted in other trading partner countries. We note that risks on our global outlook have increased, but not to the extremes that we saw at the height of the crisis. We now estimate that the New Zealand economy has grown at a stronger pace through December and March quarters. We're expecting growth to increase to around 4% next year, but we do note that this is a subdued recovery relative to what we've seen in previous recoveries. The policy stimulus that we've seen from government and increased consumer confidence have acted to increase household spending, but households still remain cautious, and house sales and credit growth are remaining subdued. Business spending is still weak, despite significant improvements in confidence. The annual CPI inflation levels currently around 2%, and we're expecting this to track within our target range over the medium term. In the short term, however, the emissions trading scheme and increased ACC charges will likely push CPI inflation to the top of the target range. The higher bank funding costs that we've been seeing have actually decreased the level of stimulus that we'd normally associate with a particular OCR level. We do expect these higher funding costs to persist, and this in turn will likely reduce the extent of future increases in the OCR required. Fiscal consolidation would also help to reduce the work that monetary policy would otherwise need to do. Ladies and gentlemen, we conclude by saying that we continue to expect to begin removing monetary policy stimulus around the middle of 2010. Thank you. That's the formal statement. We're happy to answer any questions. To assist, I've got John McDermott, Chief Economist, and Dean Ford, Head of our Forecasting. Thank you. Any questions?
Dr. Bollard, given your comments about funding costs, how much higher do rates need to go to get back to what you would consider a neutral level, a more natural level than they are at the moment?
Well, we haven't made specific estimates of that. To some extent, this is going to be a try and see, but we do recognise that we'll be dealing through the period with different conditions from what we've seen historically, and initially, of course, we'll be simply looking to reduce monetary policy stimulus, and it's quite possible that that might be achieved with less of an increase than we would historically have to do that. That's for a number of reasons, but the most obvious one is that funding costs are higher, there is more of a premium in there, and we expect that to come through and continue to come through if and when we do OCR increases. In addition, of course, you've got people who are borrowing much shorter term now, so the average duration of mortgage loans has gone down to less than a year, so you'd expect that to have a faster impact. We may see some changes in behaviour and more guarded, more cautious behaviour by households and businesses in the face of OCR increases as a result of the experiences they've been through in the recession. And we've yet to see what is to come out of the budget, but if some of the speculation is correct and there is some tax treatment around housing investment and property investment, then that might have some impact as well.
In terms of that speculation, what though about a rise in GST, both in terms of whether it would have any secondary effect on inflation, but also whether there'd be any dampening of economic activity as a result?
Well, I mean, that's pure speculation. It obviously depends on what else is happening at the same time. So if there's a tax package where you've got some reduction in some taxes and some increases in other ones, for example, GST, then we'd certainly want to look at the whole thing and wouldn't necessarily expect to see a net positive or net negative effect. On the inflationary impacts of a GST increase, if we were to see one, well, we've been through, we can be a little bit clearer about this because we've been through it twice before with the original GST and then the increase from 10 to 12.5%. And the policy targets agreement is quite clear for us as to what we do. We look through first round effects. We would move the official cash rate only if we saw people trying to take advantage of an increase in GST to otherwise increase wages or margins, and so we'd stand against any second round increase like that. I suspect that'll be less of an issue with a GST increase because it's pretty clear to every consumer just what the price increase is, how it's calculated, and it's very transparent.
Dr. Bollard, are you seeing signs of a rebalancing in the economy? You seem to have less concern than you did last year about a recovery that was led by housing and consumption, and it might not prove very durable.
Yes. Initially, we did wonder whether we would see a sudden resurgence in the housing market. That hasn't happened. That's less of a concern for us. We're still looking at this recovery in the housing sector. We do see some recovery, but not to very strong levels, and that's even in the face of significant demand for housing. We are seeing something of a rebalancing going on, and I guess the key issue for all of us is how much that's a one-off or temporary effect and how much it's enduring. We are forecasting a huge improvement in the current account deficit from around 9% deficit last year to getting up to only 2% deficit. Now, we all know, as is explained in the statement, there's a number of specific reasons around that. But we are seeing, consistent with that, an improvement in terms of trade, an improvement in export prices, an improved export story, and that is part of a rebalancing that we've all felt needed to happen. So, yes, we are seeing some rebalancing, yet to see how permanent that is.
Dr. Bollard, you've said in the past that you're keen on some sort of tax reform around the property sector. What's your reaction to the government's indications so far in the Prime Minister's speech and since then about the types of reforms that they're talking about in the budget?
Well, we haven't seen the budget. I don't know if you have, but we'll wait and see it and see what the impact is. Our views are well known. We've really nothing more to say. We'll wait for the budget.
Dr. Bollard, given what you've said, what's your expectation for the housing market this year? It's been fairly flat, as you say, fairly weak in the last few months. What's the picture? Do you want to handle it?
I mean, in the short term, there's a great deal of uncertainty as investors and potential house owners sort of try and figure out what the potential new rules are around tax, obviously. So there's potentially some downside in the very near term. But of course, we still have population growth coming from net migration. And so over the sort of 3-year horizon, we see house prices in normal terms increase very modestly, and probably in real terms, so after adjusting for inflation, pretty flat.
Dr. Bollard, you've said that the increase in funding costs of around about 130 basis points is likely to continue out for some time, and that more people are likely to borrow it for more variable rates than fixed rates. How do you think that will change the Reserve Bank's ability to move the economy around for the longer term?
Well, of course, we're looking to stabilise prices in all of this, and that will continue to be our main concern. We've seen, as you all know, some resurgence of risks around sovereign lending. I think that's really the financial markets taking on board the fact that there are very big requirements for funding governments through this next decade, not just short term. And they're only now getting on top of understanding what that means. In addition, there's still a very big premium for risky investments out there. So our view is we'll see some of that wedge, if you like, in borrowing costs continuing for some time. As I said, that actually means that the markets have already carried out a little bit of a tightening in the New Zealand system without us moving the official cash rate. And it does also mean we believe that when we do move the official cash rate, that we'll see that reflected, that increase reflected through in broad terms. And we believe households are more sensitive to that than they might have been in the past, so they'll be quite reactive to it. I don't believe that makes difficult conditions for monetary policy tightening. It generally makes it, I believe, easier, and hopefully means that we don't need to push rates back to the sorts of levels that we've seen in the past when we've been pushing against a housing market, a long-term borrowing pattern, and very cheap funding.
Dr. Bollard, could I clarify, what are your expectations for how much energy and fuel costs will go up under the ETS? And are you concerned about that and recent rises in petrol prices sort of knocking the rest of household spending down a bit?
Well, I'll put the first part of my question to Dr. McDermott, but the second part, are we concerned? Well, you know, we still note pressures in both the traded and non-traded parts of the CPI. There's parts of the world economy that do show some strength at the minute. Of course, oil prices are reasonably high. You'll see it in some other commodity areas. We do still urge that those parts of the economy that are able to pass on increases don't just do that without thinking about some of the implications. And of course, this is going to be a continuing issue around the electricity sector in New Zealand as well. On the pass-through?
Yeah, when we're looking at ETS, I mean, the very immediate impacts will add about 0.4 to the level of CPI. Half of that will come very directly in terms of liquid fuels and electricity prices and so on, and about half will come from other increases directly related to energy.
Do you have an estimate? Sorry, do you have an estimate of the fuel and electricity price increases within that? What are you assuming?
So the contribution is about 0.2% on the CPI, but I'm not sure about the exact price of petrol that results from that.
But to go back to your question, yeah, people who are able to pass through price increases at the minute do need to think about the broader implications that they've got for a fragile economy. We're talking about growth. It's reasonable numbers, but it isn't robust growth, and it's not robust until we see business investment and household consumption pick up more.
Sorry, Dr. Bollard, I mean, in terms of the increased savings rate for households, is that mainly them paying back debt, or is it putting a bit of money offside in the bank? And I guess in connection with that is the KiwiSaver scheme having any effect there as well?
We haven't looked specifically at the KiwiSaver effect. I think those numbers are still relatively small compared to household balance sheets generally, but you've certainly got a change in view from households who are saying they don't want to carry the levels of debt that they were comfortable with 2 years ago, and they're more concerned about house values, and of course they're getting some very good rates just on deposits in the banks these days because there's strong demand from the financial system for funding for retail deposit funding. So that's quite attractive as well. Yes, we're seeing the net rates of dis-saving going down quite significantly. Again, I'd make the same comment as I did about the balance of payments. We're not clear yet how much that's an enduring fact, or how much it's a one-off adjustment, or how much it's a temporary effect.
Dr. Bollard, you've said in the monetary policy statement you expect aggregate export prices to stabilise at their current high levels. We've seen a real improvement in terms of trade, and the currency's still falling. There's talk about oil prices continuing to rise and developing economies growing fast. Why do you say that export prices will stabilise? Wouldn't they continue increasing?
Well, it might make a distinction between commodity prices and some of our export price numbers. Dean or John, do you want to?
So there's a couple of things to consider here. So we've seen obviously aluminium prices and meat prices still shooting up quite a lot. Offsetting that, we know that the EU and the US have stockpiled quite a lot of dairy products, so that could offer some offset. But probably the bigger issue is that we know the world economy's recovered, but it's still quite weak. But despite that, commodity prices are very close to their all-time highs, and so you can't really be sure why it is that commodity prices have gone up by so much. So we've taken a conservative judgment between maintaining the momentum we're seeing and not really being able to explain the strength in the level.
Sorry, you caught me unawares here. The rise in bank funding costs, I think you've got a figure of around 150 basis points or something like that. At the same time, there's your prudential regime, which is being phased in. I don't recall a figure around that. I think it was 0.2, 0.3.
Not sure what you're talking about there, Rob.
Okay. Your prudential liquidity regime, which is being brought in over the next few years, I was just wondering what impact that was having on those funding costs compared to the other thing you've talked about here.
Well, okay, a number of things going on. We have brought in phase one of a prudential liquidity scheme, which has got a core funding ratio requirement, which requires banks to hold a certain amount of their funds in offshore long-term or retail deposits, not to get away from this reliance on short-term foreign funding. They've already done that. They've reached the levels required for our phase one of that. They actually, I believe, had been doing that in response to market requirements and general credit rating agency views. So I don't think our liquidity policies had any particular effect on funding costs at the minute. We'll keep watching that, however, because we do need to be aware if that were to have an impact through a spongy credit recovery. We are very aware at the minute that credit in both the household sector and the business sector are really going nowhere just right now.
Dr. Bollard, are you concerned that potential problems in the finance company sector, particularly those lending to small business in the next 6 to 12 months, as the deposit guarantee schemes are unwound and other things, could derail particularly the small to medium business sector, which in some cases depends on these finance companies for funding? Well,
Bernard, don't want to talk about finance companies, particularly talking about the monetary policy statement here, but in terms of the macroeconomic effects of finance company weakness, finance companies play an important part in New Zealand funding, and 2 of the 3 roles I think are very much intact. That's consumer finance and plant and equipment financing. The 3rd role, of course, is land and property development and mezzanine financing, and that has been hit quite significantly. So I think it's fair to assume that does leave something of a hole when it comes to funding certain classes of construction, such as apartment buildings and major residential subdivisions. And we'll be watching how that gap can be filled with a recovery from the finance sector and funds you see going in from other sources. But I think that's certainly something that we do need to keep an eye on. I'd say it's more of an issue around land and property-based lending than around small, medium enterprise lending per se.
What's your view of the bank credit lines to business at the moment? Has it been restored to sufficient levels?
Well, you'll recall we were concerned about a year ago at the fact that bank credit lines have got much tougher to get with much tougher covenants. I think the situation's changed now, and it's actually demand that's soft rather than supply being soft. And we're hearing from banks who are very much ready to lend and are seeing very repressed demand from business customers. So we've really got to wait until we see businesses getting enough confidence to increase investment and decide that their own balance sheet restructuring has gone far enough and getting out and borrowing again. I don't think there's any structural impediments to that, just the price and the confidence.
How would you describe your relationship with the government at the moment, given that the Prime Minister seemed to be rather upset about you saying that we wouldn't catch up with Australia by 2025?
I describe my relationship as normal, good and professional. Thanks, Barry. Thanks for asking that question.
When you do start to raise interest rates, are you going to still do it in meaty chunks? And what are meaty chunks?
Well, we've been thinking about crumbs off tables and things like that as an alternative, but no, we'll wait and see when and how we do it. We're still, basically we're still talking about a world recovery that's fragile, and that's what we're really waiting to see develop. We've had the advantage of watching how Australia has tightened, and when the time comes we expect to do it within the shadow of Australian rate increases. So I think all options are really open at the moment. We of course brought the rates down in some big amounts, but we don't anticipate having to go up to those sort of levels either. So I'm not exactly answering your question because we don't know yet. We'll wait and see what's required.
Just a quick one on the housing market. Do you believe that there's still an undersupply of housing, and is that demand likely to put some upward pressure on prices?
Well, that all depends on what New Zealanders are thinking about household composition. There has been an increase in number of people per dwelling over this period. That's the sort of thing you'd expect to see during a recession and a rebalancing of balance sheets. We don't know how much of that's permanent. We are getting quite positive demographic and migration growth, and we haven't had a lot of out-migration either, so we believe that has contributed to growing fundamental demand for housing. At some stage that has to be met. So yeah, we think there's a growing gap in there that will be met eventually.
The proportion of mortgages that are now variable rather than fixed has increased in the last few months or so. Do you think this increased funding cost issue will last for long enough for New Zealanders to go to the situation they have in Australia, where most people are on variable rather than fixed? At the moment, still more people are on fixed rather than variable here.
Well, I guess New Zealanders are coming to terms with an increasing yield curve of the sort they haven't seen for quite some time. But that's been pretty well signalled, and it's got people have had a lot of room to think about that and adjust to it. We might see some of that, but we're not expecting to see a huge change in borrowing behaviour. Well, thank you, ladies and gentlemen. If there's no more questions, that's the end of the press conference. Thank you very much for coming.